Understanding Jumbo Pools, a comprehensive overview. When delving into the world of mortgage-backed securities, MBS, it's essential to understand the different types and their implications for investors. One noteworthy category of MBS is the jumbo pool, which is characterized by its structure and risk profile. This article will explore the intricacies of jumbo pools, how they are created, their benefits and risks, and how they differ from traditional mortgages. What is a jumbo pool? A jumbo pool is a type of pass-through security derived from Ginnie Mae 2 mortgage-backed securities that are collateralized by a collection of multiple issuer pools. Unlike single-issuer pools that primarily consist of loans from one lender, jumbo pools aggregate mortgage loans with similar characteristics from various lenders, allowing for a more geographically diverse array of properties. Key takeaways. Diversification. Jumbo pools are comprised of mortgages from multiple issuers, leading to reduced risk related to local economic conditions. Predictability. The principal and interest payments received by investors in jumbo pools are predictable and less volatile compared to single-issuer pools. Risks. Early payment due to refinancing and shrinking principal payments are potential risks associated with these investments. Anatomy of jumbo pools. What makes up a jumbo pool? Jumbo pools consist of mortgage loans that are grouped together and sold as securities to investors. The formation of these pools involves several steps. 1. Commitment application. An approved lender applies for a commitment from Ginnie Mae. 2. Mortgage pool assembly. The lender acquires or originates mortgage loans and compiles them into a pool, ensuring diversity across geographical regions. 3. Security sale. The lender submits necessary documentation to Ginnie Mae through a pool processing agent, who prepares the securities for investors. Benefits of jumbo pools. 1. Reduced risk. Due to the diversification of loans across multiple regions, jumbo pools are less susceptible to localized economic disruptions. 2. Stable cash flow. The limited variation in interest rates, usually within 1 percentage point, enhances the predictability of cash flows for investors. 3. Government backing. Loans within jumbo pools typically come with varying levels of government guarantees, further enhancing their stability. Risks associated with jumbo pools. Despite their benefits, jumbo pools are not without risks. Investors should be aware of the following. 1. Early payment risks. Homeowners may pay off their mortgages early, especially if they refinance at lower interest rates. This leads to a decrease in expected cash flows for investors. 2. Principal shrinking. As loans are paid down, the principal amount shrinks, subsequently reducing the interest payments. For example, if the initial principal is $10,000 at a 6% rate, interest is $600. However, if $100 is paid down, the next interest payment would only be calculated on $9,900, yielding $594. These risks are inherent in all mortgage-backed securities, not just jumbo pools. Jumbo mortgage versus regular mortgage. It is important to differentiate between jumbo mortgages and regular mortgages. Jumbo mortgages, typically used for financing expensive properties that exceed conforming loan limits set by the Federal Housing Finance Agency, FHFA. Jumbo loans are not backed by Fannie Mae or Freddie Mac. Regular mortgages, these generally cater to the average homebuyer and fall within FHFA restrictions on loan size, making them subject to tighter underwriting guidelines and lower interest rates due to the government guarantee. Types of mortgage-backed securities. In addition to jumbo pools, mortgage-backed securities can be categorized into 2 common types. 1. Pass-through securities. These are structured as trusts where mortgage payments are collected and passed on to investors. 2. Collateralized mortgage obligations, CMOs. CMOs consist of tranches that have specific credit ratings and rates, providing varied cash flows to investors based on their risk appetite. Conclusion. Jumbo pools serve as a vital segment of the mortgage-backed securities market, offering investors a diversified, relatively safer investment option compared to single-issuer pools. Their structure allows for predictable cash flows, although investors must be cognizant of the risks involved, particularly regarding early payments and shrinking principal. Understanding the nuances of jumbo pools is essential for any investor looking to navigate the complexities of modern finance and mortgage securities.